Hello, my name is Marcus Day, and I'll be talking to you about a guide for investing. Where does the issue start? Very small percentage of high schools require a personal finance class to graduate. In 2017, Desjardins stated only 16.4% of U.S. students were required to take a personal finance course to graduate high school. However, this number has improved over the last 3 years, and in February of 2020, Rosenbaum reported 21 states require high school students to take a course that includes some type of personal finance content. However, in Ohio, the state testing in high school for the class of 2023 and beyond will be in the areas of English 2 and Algebra 1. Financial literacy will not be tested, and this came from the Ohio Department of Education's website. It seems that high school leaders and state education organizations realize the importance of providing students with personal finance courses, but the amount of time that can be devoted to this course is most likely limited by funding and staffing. This puts most of the burden on the individuals. Me personally, when I was in high school, it was not required to take a personal financial course. However, I took it upon myself to take 2 classes as electives. Becoming educated in the stock market and investing is a personal decision. If you do not take any of these classes in high school, there are tutorials online and financial advisors that are willing to help beginning investors understand the stock market and how to begin making investments. What follows will be a detailed plan of how to begin learning and researching companies in order to select companies that may be good investments. So where do you start? As I stated in the previous slide, take it upon oneself to learn more. Educating yourself is the best way to become more knowledgeable on a subject. Many tutorials can be found online via YouTube, other financial websites such as The Balance or Schwab.com. There's financial advisors, and decide what your investment goal is. What are you trying to get out of investing? Are you looking to save for the future, plan for early retirement? Are you wanting to save for 5 years and pull it out and buy a new car, make a down payment on a house? These are all things you need to consider when looking to invest. Throughout this presentation, the goal is to help the average American understand the process behind picking a company with whom to invest. What to look for in a potential investment. 1. A reasonable price-to-earnings ratio compared to others in the sector. What is the price-to-earnings ratio and how does one calculate it? The price-to-earnings ratio is how much a shareholder pays per share for $1 of earnings. To calculate the price-to-earnings ratio, you divide the price per share by the annual earnings per share. 2. Price-to-book ratio greater than 1. What is the price-to-book ratio and how do you calculate it? The price-to-book ratio compares a company's market value to its book value. This ratio is calculated by taking the current share price and dividing it by the equity per share. An answer less than 1 indicates that the company may be earning a negative return on their assets, which is something you should look to avoid as an investor. According to the website myaccountingcourse.com, a price-to-book ratio greater than 1 could indicate that the company has healthy future profit projections and the investors are willing to pay a premium for that possibility. So any number greater than 1 equals a value greater than the value of assets, and that is good criteria to look for as an investor. 3. A price-to-earnings growth ratio below 1. What is it and how do you calculate it? The price-to-earnings growth ratio is a good metric for a company that is showing rapid growth, which allows the investor to determine if the current price-to-earnings is justified. You calculate this ratio by taking the PE ratio divided by the projected 5-year earnings growth rate. A PEG below 1 means the company is undervalued and would make a sound investment because the company's potential growth has yet to affect the share price, according to Schwab.com. 4. Return on equity ratio in the 17% and up range. What is it and how do you calculate it? Return on equity determines how well a company uses their own investments to generate growth and earnings. Return on equity is a measure of financial performance calculated by dividing the net income of the company by the shareholders' equity. Return on equity ratios can be broken down into 3 ratings. Very good, which is 17 to 20%, excellent, which is 20 to 25%, and superior, which is 25% and up. Ideally, as an investor, you would like to invest in a company that has an REO in the 17 to 25% range. Even so, there are good investments outside of that area. 5. Debt to equity ratio below 2. So what is the debt to equity ratio and how do you calculate it? The debt to equity ratio compares a company's total debt to their total equity. A high ratio would indicate that the company relies on creditor financing, such as bank loans, compared to investor financing, which would come from their shareholders. To calculate this ratio, the total debt is divided by shareholder equity. The lower the ratio, the better. Try to avoid anything above 2. And finally, number 6, the current ratio between 1 and 3. What is the current ratio and how do you calculate it? Current ratio is a measure of the ability of a company to pay back their short-term obligations, loans, anything due, short-term obligations or anything due within 1 year. To calculate this ratio, take the total assets of the company and divide it by the total liabilities of the company. A current ratio value below 1 means the liabilities are greater than the assets. A current ratio value above 1 means the liabilities are less than assets. An investor would want a value above 1. Anything above 3 means the company is holding back assets. We're going to be taking a look at the Ford Motor Company and their 6 ratios and deciding if they meet the criteria for a sound investment. First, I'm going to give you a little background on the Ford Motor Company. Over time, Ford has been a fairly consistent company to invest in. The company has been around since 1903, and they have more than left their mark on the automotive industry. Since 2015, Ford has given out a dividend of 15 cents a share as a thank you to its stockholders. Ford reached its peak cost per share value in 1998 at $33.76 per share. They were affected by the recession in 2007 just like everyone else. However, they recovered fairly quickly, going from $1.87 per share in 2008 to $10.80 a share in 2009. Since then, the company has hovered around that $10 a share range. Due to COVID-19, the share price has hovered around $5 a share, but is slowly and steadily rising again, as would be expected by a well-established company. And this came from the Ford Motor Company's overview on Yahoo Finance. So now let's take a deep dive into their ratios. Their current ratio is 1.18. The debt to equity ratio is 4.72, and both of these meet the check marks or benchmarks that we would like to have in a company that we're looking to invest in. Return on equity is 0.13%, which falls outside of our benchmarks that we would like to see in a company to invest in. Their price to earnings growth is 0.82, which falls in line with where we would like our ratios to be. The price to book ratio is 0.67, which is below 1, which is what we like to see. The price to earnings is $268.50, which is not what we'd like to see, and this means that the company could be overvalued. So just to review the checklist and the benchmarks that we'd like to see when investing in a company: a PE below the sector average. So the price to earnings was above the sector average for Ford Motor Company. A low debt to equity. Ford Motor Company met this benchmark. A current ratio between 1 and 2, which they meet at 1.18. And finally, a reasonable price to earnings growth ratio and price to book ratio. Their price to book ratio is reasonable for the company or for the company sector and sector average. However, the price to earnings ratio is way above the sector average, which means that they could be overvalued.
Some self-help resources include The Dave Ramsey Show, YouTube videos, and Yahoo Finance. We will take a deep dive into each of these in a second.
The Dave Ramsey Show is a great place to get financial advice and to get your mind thinking about becoming an investor and things you can do. Here are some of the latest shows that he has published and recent ones. You can go through and listen and watch all of them. They're all in the archives. Another self-help resource is Self-Help Investors is Ryan Scribner. This link here takes you to his page, and you can go through and see some of the videos that he has on stocks, such as how to value a stock and stock market for beginners.
Yahoo Finance is a great place to come and get financial resources from companies that you are interested in.
We will look at the Ford Motor Company for our example, since we have already talked about them in the presentation. So we will go to the company profile, and the company profile provides sector and industry the company is a part of. The profile also provides a brief description of the company on what they do and when they started. Right here you can see the sector and industry, you can see their key executives, and right here you can see the brief description. Next we'll go to the historical data section. The historical data section breaks down the share price for any time period. You can go through and set these to however you would like, and you just hit apply. This can be very useful in deciding if the company's share price is consistent. Does it fluctuate by large amounts every week, or is it steadily growing? Next, we will go to the statistics section. This section is also very helpful as it helps break down many of the ratios that we talked about in this presentation. Again, one does not need to know how to calculate them, but should be able to understand them and form their own opinion on what they think is reasonable. Right here you see the price to book, the PEG, profit margin, return on assets, return on equity. The next one we will look at is a chart. The chart performs the same function as the historical data section, but it presents it in a line graph, allowing an investor to see the fluctuation of the share price better. The share prices of companies can also be compared. Here and click on comparison, and we'll type in Tesla just so you can get a comparison. And now we're seeing both companies being compared in this line chart. And next we will go to the company summary section. And this breaks down key numbers and ratios, the performance outlook section, recent news to the company, and it recommends other companies to watch based on what other investors look at. We have the previous close, the open, market cap, PE ratio, earnings per share. We have a chart right here. People also watch General Motors, Bank of America Corporation, Verizon, Facebook, and right here you can see that Yahoo Finance says that Ford Motor Companies is overvalued. In conclusion, how can we improve the financial literacy when it comes to investments? As discussed earlier, financial literacy is not an emphasis in American high schools for a variety of reasons. Knowing that young Americans are leaving high school without sufficient investing knowledge gives financial institutions such as banks, investment companies, and government-level treasurers the opportunity to provide financial literacy outreach to the general public. We may not be able to fix the financial literacy at the source in the high schools due to lack of funding or staffing, but we can help curb the issue once they become adults. There are multiple ways to educate oneself, and this is the best way to do it, as there's no better way to learn than self-educating yourself. Individuals can become more active at reviewing financials and understanding key ratios. Additionally, beginning investors can seek new knowledge on the topic by reading books, magazines, blogs, or even listening to podcasts to become more financially literate. It's something everybody can do. It's not rocket science. The internet's your friend here. Remember, the overall goal is to buy low and sell high.
Here are my references, and this concludes my presentation. Thank you for your patience and time. I hope you enjoyed.